Introducing Ausbiz Capital GrowWise, a new fund which combines institutional insight and experience with a target return of 15% per annum.
Our fund mirrors citing GrowWise, backed by an 18-year track record with historical 21% average annual net return. With more than $1.45 billion under management, the citing GrowWise Fund is led by award-winning global portfolio manager Ivan Sherman. The same strategy is now available to Australian investors from as little as $5,000. Discover Ausbiz Capital GrowWise, investing informed by experience.
This program is brought to you by LGT Crestone, local private wealth expertise backed by the stability of a global presence.
Good Friday morning. Welcome to the Global View. I'm Nadine Blaney, and it's really nice to be here with you to start the final session of this trading week. And what a note we're getting started on. We saw another record finish for equities in New York, particularly the S&P 500 and the NASDAQ. So it was inspired by a positive potion of solid earnings, economic data, and as the U.S. president cooled his heels when it came to tough talk around firing the Fed chair. Yet the NASDAQ, as you can see, posted the biggest gains with tech shares outperforming. Financials led the S&P gainers. Healthcare, though, was the worst performing sector. Now, Netflix shares edged lower in extended trade despite lifting its revenue guidance for 2025 to $44.8 billion and beating the street. It posted to healthy subscription growth and ad sales, also pointing to the final season of the Squid Game and the weakening U.S. dollar. In other earnings, PepsiCo results exceeded expectation on international growth and a rebound in demand for its fizzy drinks and processed food. On the other hand, Abbott Lab shares tanked after warning it's expecting more than $1 billion in headwinds this financial year, with COVID-19 test demand waning, the impact from tariffs, and the U.S. government's foreign aid freeze. Elsewhere, United Airlines stock dipped and then advanced after a strong report indicating increasing demand. GE shares, though, did ease after it lifted its full-year forecast, but U.S. Bancorp shares fell after its third-quarter earnings income forecast missed estimates. Elsewhere, Meta shares fell after it settled an $8 billion shareholder lawsuit over privacy matters. Tesla shares dipped on news it's facing a lawsuit over insurance claims. And Amazon shares reacted to news that it will cut jobs at AWS as AI costs rise. And in keeping with the dominant theme these days, Talon Energy shares jumped 15% in after-hours trade after it agreed to acquire 2 power stations in the U.S. Northeast. Also, shares of crypto-related stocks were mostly higher after the U.S. House passed a bill to develop a regulatory framework for cryptocurrencies and expand oversight of the industry. Bitcoin was under little pressure in the U.S. session, but is still trading near a record high. Upbeat economic data also fueled the rally. So retail sales were up, an expectation beating 0.6% in June after a 0.9% drop in May. However, part of the rise was likely due to tariff-driven price increases rather than volumes. That being said, hospitality sales rose 0.6%, an indication that people are, in fact, still spending. And weekly jobless claims fell 7,000 to 221,000. That's the lowest since April. U.S. 10-year yields fell to 4.46%, with markets pricing no chance of a Fed rate cut on the 31st of July. That being said, U.S. SF President Mary Daly says it's reasonable to expect 2 rate cuts before the end of 2025. But Bostic says he supports holding interest rates steady, pointing to inflation data showing pricing pressures. The U.S. dollar rose, the Aussie dollar sitting at 65 U.S. Keep in mind that softer labor data here locally yesterday. And in Europe, consumer price inflation was finalized with the core measure at 2.35% year on year, as expected. In commodities, Brent crude rose 1.5% to $70 per barrel. Copper fell 0.5%. Iron ore rose 0.9%, and gold fell just marginally. Well, let's get more on what we're looking at when we consider U.S. markets with a focus on the bond market. Where are the opportunities when it comes to fixed income? Really pleased to welcome back to AusBiz Tony Crescenzi from PIMCO. He's joining me now live. Tony, good evening to you. Thanks for sticking around to speak with us. I really am keen to get your view on where we sit when it comes to the appeal of fixed income.
I've been in the bond market for over 30 years, and you'd expect me to say, based on where yields are relative to that 30-year period, that it's an attractive period for bond investors. In fact, I would say and we would say at PIMCO, it's a target-rich climate. To sum it up, yields can be gained somewhere between 5 and 7% on double A average credit quality portfolio. What does that mean? Well, double A, according to Moody's, the rating agency, means that over time there's a 99.98% chance of getting your money back. So this is another way of saying that an investor needn't do much in the bond market to achieve a lofty yield range, and that 5 to 7% can be gained by a combination of U.S. treasuries. Of course, those are the lowest yielding. Some corporates, of course, about 25% in some major indices. Mortgage-backed securities, a little bit heavier dose of that, where yields are 1.5 points over treasuries, and a dose of asset-backed securities and the like. So it's a very good target-rich climate. An investor needn't do a lot to get a very attractive yield.
So you would consider holding cash to be, not advantageous, not as advantageous as being in this fixed income mix.
That's right, Nadine, because the thing people often ask us at PIMCO and me when I go on the road and client meetings, etc., what keeps you up at night? Of course, there's lots of things we could rattle off. Some could talk about tariffs, geopolitics, etc. I'll leave those ideas to others. But the thing that keeps me up at night is failing to lock in today's relatively high interest rates. Sure, it's been a several-year period where an investor could stay in short-term instruments, cash investments, and reap a reasonable return without the volatility that you can sometimes see in longer-term bond prices. But what if the Federal Reserve begins to cut its policy rate? What if the U.S. economy slows and longer-term interest rates begin to fall? Then you'll have failed to lock in. One final point on that. U.S. homeowners were very masterful in locking in low mortgage rates. Many Americans, over 90% of Americans, have mortgage rates that are significantly below today's rates because they locked in 30-year mortgage rates. In the same vein, they should consider locking in these high interest rates. On the debt side, they'll be paying a low interest rate. On the income side, they'll be receiving a high interest rate, sort of like a bank. And so I think it's what investors should be thinking about today.
Interesting. So when you are thinking about duration then, how does an investor approach duration when it comes to bond exposure?
Well, Nadine, luckily history provides us with a guide. We know that dating back to 1978, using a major bond index as an example, the Bloomberg Aggregate, as it's called today, it's had many names over the years, but with a 94% correlation, meaning 94% chance of it happening, at least historically, the starting yield was the determinant of the 5-year rolling return, which is to say that over a 5-year period, you'd be able to say, and so 5 years from now, in 2030, that the return per year was roughly equal to what the yield is today. So that Bloomberg aggregate, for example, today was about 4.7. So with 94% confidence, I could say that that's likely 5 years from now, the return that you'll get. But of course, as I said, you can get better than that by moving out into other instruments and going a little bit off index to pick up yield. And so I say run, don't walk from cash to intermediate maturities, meaning between 5 and 7 years. An investor needn't go much further out. And of course, going further out on the so-called yield curve means taking a little bit of risk with the U.S. and Uncle Sam's fiscal problems.
Yeah, which are big, which we won't solve here. So we might just put that to one side because there's a whole conversation to have around that de-dollarization, de-treasuryization, or however you want to think about it. But just on some of the risks, is that why when it comes to corporate bonds, you're talking, double A rated? Like you're not going down the risk or up the risk spectrum, are you?
No, no. So consider so-called junk bonds or the high yield bond market. Those yields might be in the 7% zone or so, in the low sevens, it depends. But of course, you're taking on a lot of risk. So we at PIMCO have a low allocation to that realm right now because, as I mentioned earlier, mortgage-backed securities, agency mortgage-backed securities, which are those that are implicitly backed by the United States government, therefore having a similar credit rating to U.S. Treasuries, those have a yield of 1.5 points over U.S. Treasuries. The high yield bond market might have 3 points over, but you're taking on significantly more risk. Where the yield spreads, they might be close to 300 today, but depending on the security. But in a recession, that spread can go to 800, which is a way of saying that prices could weaken on those, and so one needn't do very much to obtain that higher yield.
Now, Tony, is there any interest in your portfolios in Australian bonds, whether that be government or corporate bonds?
There is. In fact, I mentioned the mortgage situation for U.S. households. It's a bit the opposite in Australia and also Canada. Canada has already seen an economic slowdown that pushed its yields below U.S. treasuries quite significantly. We're not necessarily expecting that to happen with the Australian yield, and the 10 years somewhere around 460, but we do think the yield will eventually fall as the economy slips and the RBA begins to cut interest rates more. The market's not looking for very much. We're not looking for very much this year, but the point is, I think that the chances of the RBA moving faster than the Fed probably are greater, and the chances of an economic slowdown in Australia probably are greater now. So we have a dose of Australian bonds in our portfolios, along with UK gilts. Their yields are similar to the Australian yields, with yields around 4.5% or so. That economy, the UK economy, likely will weaken because of fiscal dilemma. In other words, Rachel Reeves, the Chancellor of the Exchequers, pushing the nation into budget cutting, and so that means a weaker economy in the future and lower inflation rate, and therefore lower yields and perhaps falling faster than U.S. Treasury. So a little bit of those, and so it's part of that story. The final word is, Nadine, is in this. It's a global supermarket of bonds, 140 trillion or so, target rich, lots to do, and so you can sort of sprinkle the portfolio with lots of different things and come up with a pretty good yield story and credit quality story.
I love that. Great turn of phrase, a global supermarket of bonds and opportunities. Now, we've sort of danced around some of the risks, geopolitics, but fiscal risks as well. One thing maybe that I think would be good to get your view on, I should add to that, Donald Trump's, on and off again relationship when it comes to the U.S. Fed Chair, Jerome Powell, who he did appoint anyways. Do you take any heart in all of this volatility and headline-driven noise that it appears as if policymakers do listen when so-called bond vigilantes get active?
I do. I wrote a book about this idea of a Keynesian endpoint in 2012. The idea that John Maynard Keynes, in the Great Depression, 100 years ago, almost, said if a nation has a problem, it should spend money. But nations have done too much of that, and we see markets around the world, in the UK most recently, of course, saying, don't do anymore, we can't handle anymore. So there are practical limits to the use of debt, and it does seem, and early April, the United States, it did seem with the weakening of the stock market that Washington was listening, watching. So what you want in the end as an investor is some sort of hall of mirrors effect, as I would call it, where not only are we looking at policymakers, but policymakers are looking at us. If they fail to do that, then there could be havoc in markets. And I think it's part of the reason why you see some backing off on this idea of letting Chair Powell go, or attempting it, even though the law firmly suggests it can't. It can't happen, and markets are saying don't let it happen. And of course, the Fed has a long history of independence.
Well, Tony, I've gone over time. Thank you so much for joining us. We hope you enjoy the rest of your evening there. Nice to see you. Tony Crescenzi there joining us from PIMCO. All right, just a very quick look at where we're expecting this local market to open in just a few seconds' time, up 32 points, 0.4%, following on from that record finish. I dare say we could achieve another record high today here as well. We'll take you through it next.
This program was brought to you by LGT Crestone, local private wealth expertise backed by the stability of a global presence.